We are kicking off the second quarter of the year today after the first quarter sent all three major indices to record highs. But this month could potentially see the rally start to peter out here. April is traditionally a strong month for markets, but that strength could stall into May, and that has happened historically during election years. So to break down what we might expect this spring, we've got John Kolovos, Macro Risk Advisors, Head of Technical Strategy here. John, thank you so much for joining us. I want to talk about kind of the technicals that you pointed out about April. As I mentioned, April, a really strong month, but we tend to see some of that strength waning in election years. So I'm curious, help me understand the dichotomy between those two things. Why is that disconnect there?
Yeah, you got it. And thanks for having me. Yeah, well, the way I'm looking at the seasonals here in the market is, choose your own adventure, so to speak. As you said, presidential years, April tends to be a flattish sort of month, which leads into quite a negative May. But if you look at all April's actually is a pretty strong month, up around 2% on average for over the last 30 years. I think the reasoning behind that is that, elections breed uncertainty, and that tends to be a moment in time, this window period leading into the summer doldrums and so on and so forth. Folks tend to de-risk ahead of election uncertainties.
And John, let me ask you about small caps here. On the Wi-Fi Interactive, I have Russell 2000. This is a 3-year chart, and if you can't see it, all I'm going to do is highlight the incredible the sideways price action that we had for years, which it has finally broken out of to the upside here. Just based on this alone or any other factors that you look at when you look at the markets, what do you think of the small cap space here?
So I could see the chart, and basically there's an old saying in the technical land, right? Bigger the base, higher into space it goes. And that is a very, very big base that it's breaking out of. So what happened at the end of March was that we had 2 consecutive months above that breakout level that you had drawn, right? That gives us more confidence in that base breakout. And the technical objective of that breakout is to all-time highs for small caps. I'm doing the math top of my head, another 15% from recent levels. So very, very constructive when you see that sort of base breakout. And really what that's telling us, I don't want to get too crazy about patterns. It's telling us that there's a transition, right? A downtrend to uptrend sort of transition, this stalemate between supply and demand, right? It's breaking in favor of more robust demand for smaller cap stocks.
Does that mean that we are just beginning a catch up in the small caps trade?
Yeah, it would imply that for sure, that there is a bit of a catch up. So the way I've been writing it in my work is that the trends that matter most are positive, like the S&P 500. The trends that we'd like to have are about ready to gain escape velocity, right? So the S&P 500 is really what drives the market. It's what people's benchmark is. Now, these smaller cap stocks are now joining, if you will, the broader equity market. So it's a healthy thing in terms of stocks as an asset class. But yeah, I would say that they're just starting to join. Historical studies that I've done that have gone back to data into the 1930s has suggested all along that small caps tend to follow large caps higher. So this is kind of par for the course-ish. It should have happened a little sooner, but it's happening nonetheless.
All right, and jumping back to the large cap space, I want to go to the Wi-Fi Interactive again, where I have the 11 S&P 500 sectors as represented by ETFs. This is a year-to-date analysis. So communication services, which has Meta and also Alphabet, some people call that tech, that's in the lead. But then we have energy, then we have financials, then we have the S&P 500, which is up 10%. Then we have industrials, and only then do we have tech. I'm just wondering, and materials right behind there. So given the strength that we're seeing in these other sectors, do you think there's too much talk about the concentration? Just wondering what your point of view is here.
Yeah, it's gotten much better, and you're absolutely right by pointing that out. If you think about last year, everyone was just dismissing the equity market, saying, "Oh, it's just a couple of stocks," right? Well, guess what? Now we have more than just a couple of stocks driving the equity market higher. So it's a good thing at least from a technical perspective. What it actually has started to do in my work, at least from the models that I have, it's telling us to, hey, maybe make some room for other stocks. Do add some of those energy names, some of those material names on the moves of these commodities like copper and gold. Make some room for them. I call them chart diversifiers, right? It can't have everything up and to the right in your portfolio. You need to have those that are going to get that relative performance handoff. And we're seeing that with energy. Industrials have been strong all along. They've been really good. Another area I guess you can think about in terms of things broadening out, This year it's really just been about financials, ex banks, insurance, capital markets, et cetera. But a lot of those bank stocks are starting to catch a bid as well.
I'm curious because you mentioned gold. I know that we spent a lot of time focusing on the Magnificent Seven, but I've wondered if we're kind of missing out on this commodities rally. What do you think investors should know now who are looking at what's happening with energy, cocoa, gold, and thinking that they might want to start to diversify into those asset classes?
Okay, a couple of things, right? One is it's a bigger picture. I do think commodities are in a secular bull market, right? So meaning the low that occurred in 2020 was likely the low for years and years and years and years to come. The longer term implication of that is that stocks and commodities tend to not trend together, right? They tend to move opposite each other. We're not quite there yet where commodity prices have ripped so much where it's like we'll have an echo inflationary boom. I think that's what most folks are worried about. So about gold, I like gold. I think gold gets to 2,500. I like gold more than the gold miners. And the reason why I say that is that, well, gold is at 10,000-year highs right now, right? Whereas gold stocks are barely off of their 52-week lows. But again, longer term, they really haven't added much alpha to one's portfolio. Gold miners have some from a tactical perspective, but I like gold more than the gold miners. And as for oil and energy stocks, yeah, I think they're quite strong and they do have a place from one's portfolio. But again, I just want to just tell clients, to viewers, I should say, is that at some point it will become a headwind for stocks. Maybe it's oil above 100 that really spooks folks out. But as of right now, it doesn't seem to be an issue.
And we didn't even get to Bitcoin, but I've got to say thank you. Lots of insight there. Really learned something. John Kolovos, Macro Risk Advisors, Head of Technical Strategy.